Hello, everybody. How are we doing today? Everybody surviving? Okay, we've got a lot of people on. Pretty much 100% turnout. Awesome. Aaron's asking, so would you build a book based on optionality rather than outright equity if you've liquidated your equity portfolio? You can do, but you need to, it's very different, Aaron, because if you're only building an options portfolio in this environment, you have to be very, very aware of the prices that you're paying on the long side when volatility is high. So you're going to be paying a hell of a lot if you just go naked long options here. So you need to be putting on spreads all the time here.
Electricity usage is something that we've looked at for quite some time in China. It's a number that can't be manipulated. And if anyone has looked at data from China, economic data, everyone knows that it is manipulated and to achieve the outcome that they want. Electricity usage is not something that can be manipulated. So we often look at that to get a gauge of what's going on in China. We can get real-time data for the US and Europe, and you can see here that things have fallen off a cliff in the last month or so. Italy, some of that is also geographic for Italy. Obviously, the northern part is the primary driver of the Italian economy, and that's where they've suffered the most. The broader Europe and broader US, though, really down on their traditional usage at the moment. So it'll be interesting to keep an eye on these numbers. But again, happening in real time, happening in a way that's in line with GDP, as the next chart will show.
Why do you bother shorting? So you guys have just got your answer to that, which is obviously a fairly facetious thing to say, but it's a sanity check here. And those of you who've obviously got long-only pensions, you know, you can understand why long short is what we advocate. The other thing as well that I point out is that even in a bull market, you can find shorts. It's lazy to pretend that you can't find shorts. You can. And you can find shorts in bull markets that actually drop in price and that you can make money out of. What I'll tell you about crude is it's still broken. Have a think about this. So with at the money options, the delta by definition at the money, around at the money, should be roughly 50 delta, because it means there's a 50-50 chance of the option being either in the money or worthless. At the moment, across the whole curve, the at the money puts on crude are trading at 70 deltas, 70. And the calls at the money are trading at 30. I think that tells you all you need to know about crude at the moment. It's still dysfunctional.
There's disparity starting to come into the market, right? It feels to me like we could be on the brink of seeing money flows and outperformance in the US relative to Europe, where Europe underperforms the US for a period of time, because it looks like the stress in Europe is far greater than the stress in the US, especially in investment grade. So European banks look like a mess. They're on the brink. And European retailers and some of the US retailers are sneaking into bad credit stress performance.
So here's a list of a bunch of stock that are under real pressure market cap side. So you can see the market cap value on the right in billions of dollars. The mid cap 400 is the index that they would go to. So you can see there, these are the ones that are all under the median of the mid cap index. So they're in the S&P. They should be in the bottom half of the 400 mid cap, and you can see a whole bunch of retail names in there, as you would expect. They've been under real pressure. The other commonality to a lot of these names and why they've underperformed is debt load. So Harley Davidson, very high debt load under lots of pressure. Apache on the energy side. We've got cruise lines, we've got retail. These names, this is where you can go and do some work on the individual names. So what we've done here is if taken a theme, got ourselves a little 10 stock, 15 stock universe, and we can go and determine whether there's opportunities in there for us to short some of these names. I would suspect that most of them have fallen pretty aggressively so far, but what we know from Macy's and from history, that if you get dropped out of that index, you're going to be a pretty consistent underperformer thereafter. Certainly until you reach the stage that value investors start coming sniffing around.
Because you are net long one put, and would an implied volatility crush mess this trade up? And that's a really good question and astute question. Now, yes, you are, by buying options, you are obviously net long volatility. However, in this strategy, with what's actually very advanced about this is in April, you're actually selling a much higher vol than in June because of two things. Obviously, because of recent volatility, given the VIX is 60 or wherever it is today, you're the curve is in something called if you use it's called like backwardization, meaning the front month is higher than the further month. So while you are long vol, a crush in the implied vols will take the April option down more than you will take the back month. So even though you're net long vol, you're probably closer to flat.
So here's Bank of America. Here's the chart. We can see it's come down from mid-Feb from 35 to a low of 17.95, which was on the 23rd. And then it's rallied. It's kind of exhausted at around 21.5, 21.25. Closed at 21.23 yesterday. Okay, so let's assume you're itching to buy stock. This guy, he's itching to double up, right? Because that's the typical response, right? Buy another 30 shares, buy another 50, buy another 100, just keep adding. Dollar cost averaging all the time, okay? There's smarter ways to do these things. So option one, let's see what happens when he just buys another 100 shares. Option two, let's see what happens if we sell an $18 put. So really what you're trying to do is you're trying to buy the bottom here, right? You're trying to get in here, okay? Option three, let's have a look at a calendar ratio put spread. So selling 2 of the $18 strike puts and buying 1 of the $21 strike put.
As Anton said, things are very, very uncertain here. We don't know whether markets are going to be down over the next couple of weeks. We don't know whether those COVID numbers are going to go through the roof or they're going to taper off. It's a time of uncertainty, and we're not in the business of making outlandish forecasts. What we are going to look at doing is trying to work out what we can do in this environment. And as it says there, see you on the other side. What I'm looking at really is seeing us on the other side of this big downturn. Things are different this time. This is a sudden stop economic change for the global developed economy, and that hasn't happened before. We've had financial downturns. We've had a whole range of other cyclical downturns. We've not had something where it stops so suddenly. It's usually a third world or developing economy proposition, and even then it's very rare. So what I'm going to talk about is, what's it going to be like on the other side in terms of markets and the economy, what parts will be different, and having a look at sort of what sort of stocks you might be able to buy.
We've made the point a number of times on this webinar, I'm going to make it again, that the market is not always the economy, because the market is a forward-looking discounting mechanism, and you always need to bear that in mind, particularly if you're watching the COVID headlines flash across your TV. So please just bear in mind that the liquidity situation is good, and this is not the end of the financial system, but it doesn't mean that we're out of the woods either. So firstly, what is actually going on? So the first chart that I want to put up is money market mutual funds flows. And what money market funds do is they provide very short-term funding to corporates and to a lesser extent to banks as well. And the reason I put this chart up is to show the difference between now and 2008. As we can see in 2008, pretty much around about the time Lehman went broke, we saw some pretty major outflows from money market funds. They so-called broke the buck. In other words, people weren't going to get their money back. Now, that is symptomatic of a banking system which is insolvent. Where we are now, absolutely the banking system has its challenges, but you can pretty much be fairly confident that with a $700 billion inflow into money market funds, who are the providers of short-term liquidity, banks are not about, major banks, I should say, are not about to go broke.
There's also golf trips that have been canceled, so those will come right back. And if you look at the back end of the year, also all the golf events were actually postponed. So the U.S. Open, the British Open was canceled, but the U.S. Open is be September, the Masters being November. So a lot of that, historically, Q2 is the most, the biggest quarter for golf club sales and apparel. But given the calendar, a lot of it will probably push to later in the year. So this stock was a $22 stock back in February. At $7, I thought it was a steal to buy, and with very little downside.